You're now listening to episode 31 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hey everyone, and thanks for tuning in. Brandon Hall and Thomas Castelli here today with Self-Directed Retirement Account expert and principal of Safeguard Advisors, Brian Eastman, to discuss various aspects of self-directed IRAs and solo 401ks, including checkbook control, the unrelated business income tax, also known as UBIT, and more. Are you ready to take your real estate investing business to the next level? Whether you're a seasoned vet or just getting started, the Multifamily Investor Nation Summit on January 17th to 19th has something for everyone. With a stellar lineup of expert speakers with proven track records for success, learn from the best, and apply everything directly to your multifamily business. Speakers include Dan Hanford, Joe Fairless, Kathy Fetke, Matt Faircloth, Ben Leibovich, Michael Blanc, our very own tax strategist Thomas Castelli, and many more. That's right, guys. I'll be there on January 18th at 2 p.m. speaking on tax issues for multifamily investors. Don't miss this incredible event designed specifically for today's brightest and boldest multifamily investors. Visit www.apartmentevent.com and use promo code THOMAS to receive $100 off the full access pass. Again, that's www.apartmentevent.com and use the promo code THOMAS for $100 off the full access pass. We'll see you there, but for now, let's jump right into today's episode. So, Brian, thanks for joining us today. Could you just give us a quick background on your story and how you kind of got started in the IRA space?
Sure. Yeah, my name's Brian Eastman. I'm a principal at Safeguard Advisors. We specialize in a very unique platform, self-directed IRAs and 401ks that offer checkbook control, something I've been doing for, about 10 years now. Just kind of, fell into it. I was a software tech guy that was sort of imploding with a couple of mergers, and I could see on the horizon I'd get to be about 40 years old and be obsolete, and was out making a living as a real estate developer, and then stumbled into the previous owner of this business and liked what he was doing so much. I saw the convergence of technology and an education-based business and real estate and all those things that really motivate what I'm doing, and segued with where we're at, and happy to step in and introduce clients over the years to the power of self-directed retirement plans and the ability to invest in non-traditional assets like real estate and the tax-sheltered retirement umbrella. It's great stuff.
Awesome. Would you be able to just give us a quick rundown on what a self-directed IRA is?
Sure. Yeah, I mean, there's two types of self-directed IRA programs out there. There's IRA-based and 401k-based with some slight differentiators on the back end at the retirement plan. And the key thing to understand with these self-directed plans is that they're still a retirement plan. All the retirement aspects of contributions and timelines and reporting and whatnot are no different than a mainstream, Wall Street managed plan. But what's different is the business model, how the plan can be invested, opening up the possibility beyond the stock market into things like real estate and private mortgages and syndicated investments and things of that nature. It's really just about plan configuration and more choices.
Awesome. So with self-directed IRAs and 401ks, a lot of people often talk about checkbook control. And from our understanding, there is out there something called self-dealing when it comes to self-directed IRAs. And could you just give us a quick idea of what checkbook control is and some of the issues around self-dealing?
Sure. Yeah, I mean, two different concepts, but let's talk about checkbook control first. And basically, it's a specialized niche within a specialized niche. You have self-directed, mostly IRA-based programs where there's an institutional custodian that acts as a processing layer. All IRAs have to have what's called a custodian. Think E-Trade, Vanguard, Schwab. Those are custodians that hold IRAs and facilitate investments in the stock market. Well, there's some specialty custodians. They generally have the word trust in their name. That do the same thing, but just have the staff training and paperwork to document the more individualized things that happen in what are called non-traditional assets like real estate. But with that non-checkbook model, the custodial model, you've got an institution that's holding the funds and signing every document and cutting every check and receiving every deposit. And while that works okay in certain very static situations, maybe buying a small crowd fund or something like that, when you start really getting into a diversified portfolio or things that are time sensitive like rental properties, it just doesn't work. There's just too many intersections of paperwork and processing delays and per transaction fees that make it very cumbersome and very inefficient. In an IRA, we create checkbook control by pushing such an IRA to the back end and having it make a single investment into a specially created limited liability company, an LLC, that we form here at Safeguard. And it's kind of like we're creating a private hedge fund for our client. The IRA will own the LLC. The client can be the non-owner manager of the LLC, and that gives them the necessary administrative authority to use that LLC as their transaction layer. So they can sign the contracts, they can fund the expenses, they can receive the income all through the vehicle of that LLC. They'll have a bank account, a checking account that they set up at the bank of their choosing, and that LLC becomes their transacting layer. That's what we call checkbook control. Same thing can be accomplished under an individual 401k, a little different mechanics. In a 401k, the plan itself is a trust. The self-employed business owner, we can talk a little bit about qualification later, but just simple to get to your point of checkbook control. The client is the trustee of the 401k trust. They have a trust account that they have signing authority for. So it's a more direct route to that same end result, which is a legal entity under the umbrella of the plan where the client has signing authority. And that becomes a fantastic and very efficient way to invest in non-traditional assets like real estate.
Just to clarify, so if I have checkbook control over one of my retirement accounts, that means that I can literally write checks to invest in whatever I need to be investing in.
Yep. It's a marketing terminology, but it basically means you have full executive authority. You can negotiate, you can sign contracts, you can release funds for payment of expenses, receive the income produced. You do it all directly without having to go through a third-party intermediary.
So talk to me about how do we get money inside of a solo 401k or a self-directed IRA, and what are some of the deadlines surrounding that?
Sure. Yeah, we'll come back and talk about rules of self-dealing a little bit later, but sticking with some of these mechanics, in either case, it's about a 3 to 4 week process from end to end to set up one of these programs. You got to keep that in mind. I always get folks calling up and saying, "Hey, I got a real estate deal I got to close next week. What can you do for me?" And I'm like, "Well, I can, raise the white flag and surrender now, or we can look at a different deal." But it's about a 3-4 week process. You're going through a regulatory format, just as if you were moving money between more mainstream institutions. In the IRA, the flow is from the old retirement plan that you have today first into the IRA account with the custodian, and then that custodian will document the IRA's investment into the LLC and send it out to the LLC bank account where you can now start putting it to work. In the 401k, we eliminate the need for that custodial layer, so we get plan documents to a client. They go open a plan trust account, and then they can directly into their plan request a rollover from another plan. And, there's details about what's qualified and what kind of money can move where and keeping, things compatible. But as long as we're effectively dealing with retirement funds belonging to a single individual of a single tax type, tax deferred or Roth, a lot of different things can be done and consolidated. And, these types of tools are a tool. They don't necessarily need to be your one and only tool. I have clients who have, half their portfolio in a self-directed vehicle and half their portfolio in a Wall Street vehicle. But you just, can you move the amount of money you want to use to invest in this fashion into either one of these vehicles? And we walk people through that process.
Perfect. And, something that one of our clients had recently asked us is whether or not when you actually go and set up a self-directed IRA, do they need to set up a TIN, tax identification number for that IRA trust?
Well, for the IRA, typically not. But in the IRA, in the checkbook IRA, where we're forming that LLC, we do obtain a tax ID for that LLC. In fact, we do so in a special manner. We kind of have to put a little bit of a round peg in a square hole. The IRS has actually directed us on how to do it, but we get it so that the IRS understands that it's the IRA, not the taxpayer, that's the sole member and tax responsible party for that LLC. So yeah, that's a critical piece, and it needs to be done the right way.
So if I come to you in July and I want to make a contribution to my IRA or solo 401k for the prior year because I want to reduce my prior year taxable income, what are my options?
It's going to depend a little bit on your situation. Normally your contribution deadlines are going to be April 15th. In an individual plan like a traditional IRA or a regular Roth IRA, you get beyond April 15th and you're out of luck. You can start, when you're talking July 2018, you're looking at the 2017 tax year, you're done. You can contribute for 2018, but not for 2017. In the employer-based formats, like a SEP on the IRA side or the solo 401k, you can actually make contributions up until your tax filing date, including extensions, which will take you to either mid-September or mid-October, depending on your business format. But in the 401k, you're only eligible to make those contributions if the plan itself was in place by December 31st of the tax year. So if you came to me in July and said, hey, I want to make new contributions, I'm self-employed, I'd say, well, we can't look at a 401k because you didn't have it in place back in December. However, there's a neat little bridge that we very frequently use in that situation, which is for that one tax year in question, we'll have the client set up a SEP IRA. They can make the generous profit sharing contribution potentially as high as $55,000 for those under age 50 and 61 for those 50 and over, depending on their income. So a nice generous contribution for that previous tax year, for in this example, 2017. Once that's done, there's going to be more horsepower, more benefit in the 401k program over the long haul. We'll switch them over to the 401k. They can start using the 401k with their 2018 contributions. And even if we're setting it up in July, they can maybe look back to, January income. They'll have the full 2018 perspective in most cases. And then they can roll in that 2017 SEP and just, liquidate and close out the SEP at that point. But it becomes a nice bridge. So there's things that can be done to get that real advantage of the 401k, which is those high contributions.
Yeah. So talk to me about that. You just mentioned that the 401k has much more horsepower than the SEP IRA. What does that mean?
Well, the top line number is the same. And again, for those age 50 and under, as of 2018, it's $55,000 that can be contributed. If you're over age 50, you get a $6,000 catch up, and that would take you to $61,000. And that's per participant. So I have a lot of clients who are husband and wife in a business. The business is doing very well. They could both contribute up to that maximum. So the maximum's the same. The difference is with the SEP, you only have one method through which to make contributions. And in the 401k, you have two. So you can get more money into the plan on less overall income. And then separately, we'll pause after this and go to there's also some Roth features that give it some additional horsepower as well. But real quick reviewing those, with the SEP and the 401k, there's an employer profit sharing contribution that can be made. And in a pass-through environment like a sole proprietorship or a single member LLC, it's 20% of the net business income up to that maximum of $55,000. In a corporation where you're paying yourself a W-2, it's up to 25% of your W-2 compensation. You don't get to look at your dividend compensation, but your W-2. So you can use that to work towards the plan maximum. And if you're highly compensated, maybe you max out with that profit sharing, which would be to your advantage because those profit sharing contributions do come ahead of 50% of the self-employment taxes. So it'll save you a few $1,000s on self-employment taxes relative to the other piece. So that's all you get in the SEP IRA. And I forget right off the top of my head, but it's about $185,000 of income that'll get you to that maximum on profit sharing. With the 401k, you get an additional form of contribution, and that's as the employee, as the participant saver in your own company, you can separately make a employee contribution. And again, for those under age 50, it's $18,500 in 2018. For those age 50 and older, it's at $6,000 catch-up rate takes you to 24. And that's just the first, say, $18,500 of after payroll tax income that you have. So if you make $23,000 gross in your business, well, net after expenses, allowing for your self-employment taxes, you can max out the plan. So for somebody who's in that, $75,000 to $150,000 worth of compensation range, by stacking those two together, they're going to get a lot more money into the plan than just with the profit sharing that the SEP offers.
Would you be able to touch on some of the Roth features that you just touched on before?
Sure. Yeah, and when we mentioned the employee contribution, the $18,500 or the $24,500 if you're over age 50, That you can elect to make on a tax deferred or on a Roth basis, or actually you can even do it a little bit of both, up to that maximum. So that's without income limitations. A lot of people look at the Roth IRA, and if they're in a more standard environment, they're income limited out of being able to make contributions. Well, you don't see that in the solo 401k. You can make that full 18,005 of Roth IRA contributions directly, and you don't get the tax deduction, but you're starting to you're paying tax on the seed, and you can grow that tax free. The longer you have, the more that's going to pay you off. So it can be a real powerful way to pursue that Roth strategy. You can also within the plan do Roth conversions. So if you set up a plan and you roll over funds from a previous tax deferred source, unfortunately, you can't roll in a Roth IRA. If you had an old Roth 401k with your employer, you could roll that. But you bring tax deferred money into the 401k when you set it up, or over a period of time, you make some tax deferred contributions. You can at any point in time make the election as the employee to convert some of that tax deferred portion of your plan over to the Roth status. Just like most of the Roth conversion style events, you'll pay taxes on the amount you convert, and you want to chat with the guys on your team to run the numbers, see what makes sense. Try not to push yourself up a tax bracket if you can, things like that. But you can convert that amount over to the Roth side. So a couple of real powerful ways to build your Roth portfolio within the plan, and you could hold both. You can have a tax deferred bucket and a Roth bucket. You can invest them separately. You can combine them as long as you're good at bookkeeping and can track the values appropriately. It's a real flexible way to go.
Yeah, we love Roths whenever possible. Roths usually make a lot of sense for a lot of people out there. But one of the issues a lot of people have misconceptions around is UBIT. Would you be able to give a quick overview on what UBIT is?
Yeah, that's a big can of worms. So I like to start at the top. So in these IRA and 401k plans, not everything you do is 100% tax exempted. The large majority of things and many things that investors are going to do are, and of course, we're all used to everything being tax exempted when we're in conventional financial products. But when you start getting out and doing different types of things, there are some activities that can create some tax exposure for one of these plans. There's three acronyms. So let's start with. There's UBIT, stands for Unrelated Business Income Tax. That's the tax itself that gets paid, like saying income tax. Well, there's a couple of ways you can create the liability to have that income tax. But the UBIT is generally thrown around as what you'll see everywhere when people talk and on the internet, and it's really just the tax itself. There's two types of income that create UBIT exposure. One is unrelated business income, or UBI, and that's generated when a tax-exempt entity, like a retirement plan or a nonprofit or any other tax-exempt, is engaging in a trade or business on a regular or repeated basis. And the idea is if that's taking place, a trade or business on a regular basis, we have this tax-exempt substantively competing with tax-paying businesses. And Congress figured out long before IRAs and 401ks existed that really didn't serve the public good. And this tax was invented back in the 1950s to level that playing field and protect those tax-paying businesses. In the real estate space, where we see that is active real estate, things like building new spec homes for immediate sale, flipping of properties, just buy, fix, resell. There's no passive component to those transactions, and that's viewed as a trade or business. And again, if it's done on what's deemed by the IRS to be a regular or repeated basis, which I'd love to give you a volume level, but there just isn't one. Probably much more than about 2 transactions a year would be a good guess, depending on other factors. But if you're doing buy, fix, sell, repeat, you're running a business, and there's this tax exposure. And the tax on unrelated business taxable income is pretty steep. It's a tiered rates, but at $12,400 of net income, it gets up into the 37% tax bracket federal. Many states will have a parallel to that. So you could very easily be paying 45, 50% tax on the gains inside your IRA or 401k, and that just isn't appealing to most people. That's typically going to be a deal killer and something that you want to strategize around. So that's the first tax, unrelated business income tax. And that applies, a real key consideration. A lot of people will throw out the language, 401ks are exempted from UBIT. No, they're not. I'll talk about what they are exempted from in a moment. But either a 401k or an IRA is going to have that tax exposure if it's engaging in a trade or a business. The other tax, and what we see more commonly, and which really isn't a deal killer, it's very manageable, is debt financed income, unrelated debt financed income, or UDFI. And that's generated when a tax-exempt uses debt financing to make an investment. There's an exemption for the 401k there when the debt financing has to do with the acquisition of real property. If a 401k was using debt in the stock market, like margin trading, it would still have the tax exposure. But in real estate, finance real estate, the 401k is exempt. And that's a key factor for people who qualify for the 401k. It really simplifies their lives. In an IRA, what that tax means is that the percentage of the income that's derived from the borrowed money, the non-IRA money on the mortgage, is viewed as taxable. So a little simple example to get your mind around how this works. So say we're going to go buy a $100,000 property, and instead of paying all cash with your IRA, we're going to put 40 down. You'd have to go get a non-recourse loan, no personal guarantee from you. You borrow that 60,000 from the bank. Well, that property is now 60% debt financed. So 60% of the income, the gross income produced by that property, is viewed as taxable. That's the unrelated business taxable income. Unrelated debt financed income. Sorry for mixing my acronyms there. And so 60% is looked at as taxable. You then get to apply 60%, that same ratio, of all your normal deductible expenses that you'd be used to in the after-tax world, like depreciation, interest on the note, property taxes, insurance, et cetera. That's going to dramatically reduce the gross income to a net taxable number. There's also $1,000 exemption off the top, which for most investors working with less than $500,000 makes a difference. So those are the deductions, and that's going to take your net taxable number to a much lower number. That net taxable numbers then also run through the trust tax table, but generally with most real estate investments, you're going to find yourself in the 10-15% net range because of all the deductions, and the tax impact is pretty negligible. I mean, you take that example I gave you, $100,000 property, 60% debt financed. Say it was, producing 10% returns and running about a 30% expense ratio to gross rents. You'd be looking at, $175, $200 in net taxable income at the end of the year. It's just not a big hit, and you're going to get the benefits of leverage and a higher cash-on-cash return. So even an IRA where you're not exempted from that tax, it can be a very positive way to use leverage. But yeah, if you can eliminate the headache and the small cost of the tax in a 401k, it's even nicer.
Awesome. Excellent breakdown. We really appreciate that, Brian. So you mentioned that 401ks avoid UDFI as long as we're investing in real estate. So that's a way that real estate investors can avoid being hit with UDFI. Just don't invest in real estate with your IRA, or at least don't invest in equity positions in real estate with an IRA. But Brian, talk to me about how we can avoid UBIT, because you mentioned that the UBIT taxes can get upwards of 30-40%. What are some things that real estate investors can do to avoid UBIT, or to at least minimize the exposure to UBIT?
There's a couple strategies. The number one is just reconfiguring the transaction so that it's a passive investment and not an active trade or business. So, flipping a house.
Yeah, can you explain how that works?
Yeah, no, absolutely. So, again, the key is just, shifting the focus of the transaction. If you were to take your IRA, your checkbook IRA, for example, and have the IRA be the flipper, well, it's a little challenging to do, for one, because you got to do everything at arm's length. You can't go out and swing hammers and be the delivery boy and stuff. You can project manage to a degree, but you're basically funding and coordinating the project via the IRA. The IRA is hiring all the vendors to do that work. So it's a lot of work and effort and whatnot. The IRA is going to generate a gross return, and if you're doing that frequently, you're going to see the taxation of UBIT apply and erode those returns. So that's typically not a positive approach. Generally, the better approach is to find a partner, a contractor, or somebody who's good at running around and project managing and whatnot, and say, here, you go buy this house and you flip this house. My IRA is going to be your bank. I'm going to lend you money. And you do a hard money loan. And you might say, 2-3 points up front, 12-15% interest, something along those lines. Usually those are short-term projects. So you might want to bank in a minimum number of months interest that you get. And that changes the nature of the transaction. When the IRA has an equity stake in the profits of that business transaction, it has the tax exposure that goes along with that. When you shift the IRA to being the lender and just receiving fixed income, irrespective of how the deal performs, now that's passive interest income, and that's not subject to taxation.
And is the same thing said for the 401ks in that example?
Yep. Same exact thing, IRA, 401k. There's no difference in this particular area. Now, Another strategy that some folks will look at when they see those flip opportunities is what we call a hybrid flip. And the idea there is when you're flipping properties, you're basically able to buy that property at a discount and add value, and that boosts the equity in your transaction, that added value. Well, if you buy it at a discount, add that value, turn around and immediately capture that value through the sale of the property, again, that's an active dealer style transaction. That's something that's going to be viewed as a trade or business and have the UBIT exposure. If you can be patient, which frankly is what retirement plans are all about, you're building future long-term wealth, and change the nature of that transaction to make it passive, well, you can eliminate that tax bite. So instead of buy, fix, sell, buy, fix, stick a tenant in that property and rent that property for a period of at least 12 months. Now it's not viewed as a flip. Now that's a passive rental asset. And in the future, whether it's 13 months or 3 years or 5 years down the road, when you sell, not a flip transaction. It's still all passive income. You're just disposing of that passively held rental property. So you eliminate the UBIT, but you still get to capture that added value. You might get some positive cash flow on the rental period, and it can really, really dramatically increase your return instead of the rushed quick flip.
So a flip property is definitely subject to UBIT, but a rental property is not subject to UBIT?
Correct. Yeah, UBIT is anything that's deemed to be passive income, and I'll explain that in just a second, is exempted. And the passive forms of income are interest, dividends, royalties, rent from real property, or the future sale of an asset that's been held to produce passive income over time. This is all for those who have problems sleeping at night. IRS publication 598 is a great read on this topic.
We'll definitely put you to sleep there, right? Talking about the passive income, that's a good segue into our next question, which involves syndication. So we have a lot of clients that will use their retirement accounts to invest in syndicates that are investing in real estate. So you might have a group that goes and buys an apartment building, and they raise, $1 million, and some of that $1 million is coming in the form of solo 401k and self-directed IRA investments. So are those owners subject to UBIT, or do those passive rules, those passive exemptions, do they still apply?
Well, it depends on what the syndicate's doing. So if the purpose of the syndicate is to go buy an apartment complex, well, that's going to, in most cases, generate passive rental income. And that's even the case, a lot of these deals, I see a lot of this myself. You get a bunch of investors together, they buy an underperforming or maybe a 1970s apartment complex. They, over a period of time, renovate it, improve the management, improve the performance of that. And then, 3-5 years down the road, there's an exit strategy to sell. Well, the focus of that is that passive rental income. It's more like that hybrid flip I described. There's enough of that passive rental component that's a passive transaction, and the income isn't deemed as subject to UBIT. If the syndicate was flipping or building a new subdivision, well, now we have a trade or business, and in a pass-through like an LLC or an LLP, the tax exposure is still going to flow through if one of the members of that partnership is an IRA or a 401k. So again, it depends on the underlying activity will determine whether that occurs. But generally speaking, those syndicates are generally pass-through entities, so the activity of the entity is viewed as the activity of the fractional member as an IRA or 401k.
So I guess just to recap right there, basically it's the IRA investors taking the form of whatever the company, whatever the LLC itself is, or whatever the pass-through entity itself is doing. So if they're flipping properties, that income would be considered a flip and would be active and would be subject to this UBIT tax.
Correct. And that's true if the entity used is a pass-through. In some cases, a group of people wanting to go do real estate development or redevelopment in the form of flips might form a C corporation instead. Then the corporation itself would be paying taxes, and an IRA would be a shareholder receiving passive dividend income. There'd be no taxation, and that would actually lower the tax rate. You'd pay corporate tax rates at 21% as opposed to trust tax rates at 37%. So if you had a couple IRA investors wanting to get together and flip, they'd be better off forming a syndicate through a C corp.
Well, there you have it for our audience. If you want to avoid the UBIT on your flipping transactions, you could do a C corp, which will get you to that lower 21% rate. Brian, thank you for explaining that. We definitely appreciate it. Do you happen to be investing in real estate yourself at this point in time?
I do. I'm not as active as I have been in the past. I've actually been focusing more of my plan activities on passive lending, which is just less time intensive. It gives me time to run my business and make it to my son's hockey games and stuff like that. But yeah, I definitely, I'm a real estate investor doing some private lending, doing some rental properties, both in and out of the retirement plan.
And when you're doing this investing, how do you end up handling your accounting and your bookkeeping? Do you do it yourself?
On my personal side, I have a CPA that I work with. On the plan side, it's all pretty, simple interest income inside the tax sheltered umbrella of the plan. If I was dealing with UDFI or UBIT, I'd be having a professional handle that for me, but I'm not. So you're just keeping the simple records I need for the 401k is easy enough to do in Excel. I don't even go as far as QuickBooks for that. So yeah, pretty straightforward.
Great. And what would you say if you had to say one piece of tax advice you ever received? What would be the best advice you ever got?
Get a professional, put you on the right path. It is something I encounter all the time. I get people trying to be the autodidact and self-educate themselves on the web and wade through stuff. And more than almost anything else in our society, the tax code is cross-referential, contradictory, and manipulated at many, many levels. And having a seasoned guide who can help you to navigate that and take all that massive information and boil it down to here's what applies to your strategy and what you're doing is invaluable. I've learned that lesson myself. I get to teach that lesson to clients, even though what I'm doing isn't the same as the tax advice, but it's so true. There's so much value in that.
We love those answers. And if you need your seasoned guide, check out www.therealestateCPA.com. Brian, what is your favorite piece of technology that you're using right now?
Oh, wow. Actually, I need to start using it more. It's a little sort of a whiz-bang, gee-whiz-bang thing. There's a phone app called Citrix. It's Centric, CENTRIQ. And basically, it's a property inventory guide. And you can scan the model badge on your refrigerator, for example, and you give them a day to process and they come back, and then you've got the manuals for that refrigerator, you've got the parts ordering for the filter and all that kind of stuff you can just go grab on Amazon. And so as a homeowner or as a property investor, you have right there on your phone all the stuff. You get a tenant that calls you and says, hey, I need new air filters for my furnace. You can say, great, these are the ones you need. I'll order them on homedepot.com and have them sent to you. And it's done. It's a 3-minute phone call instead of a whole big adventure. It's pretty cool tech. I like it.
Awesome. We always love to hear about new tech and new ways people are using it out there. Brian, if our listeners wanted to get in touch with you, what would be the best way for them to do that? 2
ways. The website is ira123.com. Lots of ways to find us from there, learn about our services. The main number is 877-229-9763. We're from 8 a.m. to 5 p.m. Mountain Time. Myself and one of our advisors aren't available. Our receptionist can schedule time to speak. And it all starts with a conversation. As I mentioned a few moments ago, everything is specific to an individual and what their situation and goals are. And dissecting that and getting to the heart of a matter is the key of what we do. And always happy to spend that time and help people see, if there's a path that makes sense.
Awesome. Well, thank you for coming on today. We definitely appreciate you taking the time to explain some of this complicated stuff to our listeners.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.